Hi, good morning. Okay, we are going to start the webinar now. This is Richard speaking. So it's 11:15. We'll start the webinar now. Uh, this usual disclaimer. Please read it. Okay, later the Hong will present on Crozier's retail trust. So we'll skip this first and come back to it later. So I'm going to start by giving an update for ComfortDelGro, which announced their 3Q results last Friday. So we have actually upgraded it from reduced to neutral. Target price also, we have raised it to $3.08 from the previous target price of $2.97. Last Friday's close was $2.98. So the first thing, this table here shows a summary of the revenue for their 8 business segments, and then this revenue for 3Q, you can see is a 1% year-on-year growth. And as you go down the bottom line, PATMI 85.2 million, which is a 5.4% year-on-year growth. If you look at the 8 business segments of bus station, rail, taxi, engineering, inspection, car rental, driving center, largely most of them had a positive year-on-year growth. The thing to look out for is mainly their bus and taxi. These two are their largest revenue generators. So for bus, there was an increase in revenue from Singapore and UK operations, and some forex losses from lower Australian dollar. Rail, you can see is 7.3% year-on-year growth. This came out from higher ridership and higher average fare. Okay, so we'll move on to the bullet points. So there was no visible impact in their revenue from their Singapore taxi business. There was no visible impact from third-party booking apps. Their taxi revenue grew 1.4. Sorry, their fleet grew 1.4% year-on-year, while their revenue actually grew 2.8%. Sorry for that interruption. Yeah, so management shared that actually there has not been any drop in call rates to their call center, and their taxi fleet has been fully hired out during the quarter. So during the briefing, I did query them on their actual level of taxis which are being sent to the workshop and the actual level of taxis which they made available, roadworthy taxis made available for hire. So what we've learned is typically they have about 100 taxis a month which are off-road for servicing and repair, and they say that this level has been maintained, and so they have not compromised on the number of taxis they have not compromised on the number of roadworthy taxis available for hire. So their taxi fleet grew and the available taxis for hire also grew. Lastly, in terms of taxi hirers, they did say that some have indeed left to join the third-party apps, but the turnover rate for taxi hirers has not been higher than usual. Second point is a smooth transfer of BSEP assets and manpower. So BSEP is the bus service enhancement program that was rolled out about 2012 or 2013. So in July this year, there was an announcement from SBS Transit where LTA will be buying over the buses from the BSEP buses from SBS Transit. So during the purchase, the original purchase, what happened was LTA lent money to SBS Transit to buy the buses, and so the bus assets are on their balance sheet as well as the loan liability. So during this transfer where the BSEP buses go back to the LTA, this will be balance sheet neutral in that the asset will come off the balance sheet as well as the loan liability. So there will not be an impact on the NTA for SBS Transit. The other part about manpower. So I think last Friday there was this news article on the aggressive hiring of bus captains by Tower Transit, and that caused the ComfortDelGro share price to drop by 10 cents. So what management from ComfortDelGro has shared about the recruitment is that, as you know about the new contracting model, the drivers are not obligated to shift to the new um, bus operator. So that's why Tower Transit really needs to uh, attract and recruit new bus captains. However, uh, the number of bus captains that they do not expect an exodus to go over to Tower Transit because there's a the current requirement is only for 380 buses, so there's a limited scope for absorption of bus captains over. Third bullet point is on Downtown Line 2. So Downtown Line 2 opens on 27th December, and as you may recall, the then Transport Minister, when he announced the opening date for Downtown Line 2, he also said that uh, there would be a 1.9% fare reduction. So for this segment, Downtown Line 2, um, we what we see is that although there will be a fare reduction, but the ridership growth should offset this fare reduction. Current ridership in 3Q15 was 78,000. We think that this would at least double. So Downtown Line 1 consists of 6 stations, and Downtown Line 2, they are going to open another 12 more stations, extending the line. So the network will actually increase. What LTA is forecasting is when the whole network, Downtown Line 1, 2, and 3, is completed, they expect a average daily ridership of 500,000 passengers. So at the moment, it's only 78,000. Think that by the time it re- for by the time it reaches Downtown Line 2, it should be more than double of this. And so this doubling of ridership would more than offset the fare reduction. Okay, now we'll move on to the main part of today's presentation, which is on an update on the industrial REITs. We had a report last week on Thursday or Friday. Um, okay, sector summary. So this is a summary of the data provided by JTC. So JTC publishes their quarterly summary for the industrial space. So first thing is occupancy. The sector occupancy moderated downwards. This was due to 1% increase in supply, which outstripped 0.8% increase in demand. Second thing that we look at is the rental index. So the rental index also softened. This this line here is for the rental index, and this line here is for the sector occupancy. Our view on the industrial S-REIT subsector is negative in the near term due to the oversupply of space. However, we point out that um, this oversupply will be relieved from 2017 onwards. So the light is at the end of the tunnel, and supply will in 2017 will go back to the historical average level again. This is a compilation of the key recurring comments that the S-REITs said during the recent quarterly announcements. So the the things, the key common things that they're saying is 4Q will be challenging, leasing market is expected to be subdued, and rents continue downward pressure. This is due to tenants being cost sensitive, slowdown of manufacturing sector, and the tenants know that there's a huge supply of space coming on stream. So they are not willing to pay high prices. They say that multi-user rent for conventional factory space will dip further, and this is the large supply that's coming on stream until 2016. Uh, Near term, business park occupancy will dip as well because there are new buildings coming on stream. But in the longer term, the rent for business park and high specs buildings will increase due to limited supply. And they also said that business parks and high specs buildings have a high level of pre-commitment. The other comment that the industrial REITs made during this quarter was about the new revision to the JTC rule for anchor subtenants, where it's been reduced to 1,000 square meters from 1,500 square meters. This is a positive thing for the landlords as this would expand their pool of qualified anchor tenants. So this shows that JTC has been aware of the tight, stringent requirement and is willing to work with the landlords to um, relax it a bit. So this table on top is the supply pipeline as of the end of third quarter. The first column is the existing stock in million square meters of each of the individual types of properties, which is a factory, warehouse, and business park. This is the remaining supply pipeline in 2015, and this is 2016, 2017, and so forth. This chart at the bottom is basically the graphical representation of this table. You can see that there's going to be a lot of factory space coming up in 2016. This is what the remainder of 2015 looks like, and so from 2017 onwards, the level is going to be closer to the historical amount of supply that comes on stream. So this is our view for the industrial REIT subsector. Firstly, in terms of add-on space, the new industrial space in 15 and 16 is about 8.5% of the current existing stock. So that will give you some sense of how much more space is coming on relative to existing space. Okay, you have to expect further downward pressure on the occupancy level as new supply exceeds new demand. In particular, the at-risk sub property type is the factory space, which is the generic type. Warehouse should have a limited oversupply risk because largely these are pre-committed build-to-suit projects or own developments. Next is business park. So we expect business park demand to remain healthy. and in the near term, lower occupancy is normal. It's expected since there's new properties coming on and they'll need to fill up the space. And lastly, it's not all doom and gloom. As I showed in the previous slide, the chart, that light at the end of the tunnel comes in 2017. This is a compilation of the quarterly results for the 10 industrial REITs listed here. So the four results points that we look at is the gross revenue, net property income, the distributor income, and lastly the DPU. So for gross revenue, you can see this is the first column for gross revenue across the board, everything green. So all the growth in gross revenue came about through acquisitions and completed AEI. So acquisitions is their inorganic growth of their portfolio where the REITs go and buy a new property. A completed AEI would be how this works is, so there would be certain properties in the portfolio where it's taken offline, where they do their AEI, and so these properties started contributing revenue again in the quarter. The next thing is a net property income. So net property income trend is dominated by the property mix depending on roll-off and acquisition. So roll-off is master leases rolling off to multi-tenancies. So typically when you roll off from a master lease to a multi-tenancy, this would negatively impact NPI. And conversely, if they did acquisitions where the property is on a master lease, then this would positively impact NPI. So distributor income largely was in line with NPI, and DPU in some cases was underperforming relative to distributable income. This was due to dilution from placements and new units issued. This is a summary of performance measures for the REITs. So there are occupancy level, weighted average lease expiry, gearing level, weighted average debt maturity, weighted average cost of debt, and the interest coverage. So this is how they stack up relative to each other. And then the last line at the bottom here, this is the sector average. So this is a simple average. If you go line by line to look who line by line in each of the metrics to see whether it's better than the sector average or poorer than the sector average, you will notice that Capital DC REIT outperforms the average in all the 6 measures, and Sabadang REIT outperforms the average in all the 6 measures. So for some of these measures, it's not a longer bar better. In particular, gearing you'd want lower as low as possible, and for weighted average cost of debt. So these are the two where numerically, if it's lower than average, so it's better than average. Whereas for occupancy, WALE, debt maturity, and interest coverage, if it's numerically higher than the average, and so that would be superior. Okay, so this is the table for the 10 industrial REITs market cap, their closing price as of last Friday, price to NAV, and their yield. So you can see that currently the sector's yield is trading at an average of 8.1%. Chart at the bottom here is a graphical representation of the last two columns, price to NAV and yield. So how you can make use of the chart is for your shopping list for what REIT you would want to identify. But so ideally you want to buy something at the top left corner where the yield is high and the price to book is low. But um, having said that, um, high yield also is a reflection of the risk involved um, in that investment. So the correct way to use this kind of short list is you have to firstly identify a REIT which has a good and strong fundamental, and then when there's price weakness and some indiscriminate selling where for no good reason and that REIT has moved closer to the top left corner, so that is when you buy it for to identify temporary price weakness. Okay, this is the last slide, the conclusion and recommendations. So currently we have two industrial REITs under our coverage, which is Soybuild and Cash. So for Soybuild, currently have an accumulate rating. Last close on Friday was 78 cents, with target price of 91 cents. The investment thesis for it is business park spaces will be in short supply as there are no new spaces coming on stream after 2016, and this could result in higher rent. The other one is a Cash Logistics Trust. We also have an accumulate rating. Last close was 935 on last Friday, target price of 110. Cash has a portfolio of warehouses with good locations near the ports and warehouse, and superior design, which is of the modern ramp-up type. And Cash is well positioned to benefit from Singapore's status as the regional logistics hub. Also, however, note that there will be some dilutive effect on the recent placement that was announced, and also last Friday, Cash has announced a proposed acquisition of another warehouse in Australia. Okay, now we'll go back to the front where Te Hong will give an update on Croesus Retail Trust.
Hi, morning guys, the Hong here. Okay, I'll next touch on Croesia's Retail Trust. So they announced the results last week, and we'll run through the numbers, basically what happened to, okay, revenue first. Revenue for first Q was up 17%, but basically if you look at the portfolio as a whole, most of their leases are all pretty long term, no escalation, no step ups. So in that sense, the performance, there is nothing out of expectations. So the primary reason for the rise in revenue is due to the one small acquisition that they did in October last year, and that contributed to the higher revenue together with the the huge rental reversion exercise that they did at one of the malls as well, Melad Shobu, one of the multi-tenanted malls that they have. And for this mall, because the previous leases, they were all mostly done in 2008. So that was the period where the property market was very suppressed, rates were very low, and so when you do the reversion last year, you actually get pretty good rental reversions there. So these two factors contributed to the increase, the jump in revenue of a 17%. And the other highlights that I want to point out is that the acquisition that they announced last few months for Torres property and the rights issue that they announced to support the acquisition, These effects are not factored into the financial statements yet. You will only see these effects in 2Q, starting 2Q16. And a few things about this new acquisition. Torai's property, the current rentals for that mall actually are at levels which are close to 20% lower than what is currently the market rates around the area. So you should expect to see a boost in revenue when the next round of reversion comes for this property, similar to what we saw for Malad Shobu, as I pointed out, which is contributing to the rise in the revenue for this quarter. So similarly, you will see something of the same effect for Torias when the next major round of renewal comes in 2018. And the second thing for this property is that the WALE is shorter. The WALE after acquisition, the WALE for the entire portfolio will be lowered from 8.6 to 8.2. So that is something that management is trying to do to get the WALE lower, because in anticipation of higher retail sales, with all the government policies now trying to support consumption spending and trying to move Japan out of deflation. So that being said, we look at the other malls. There's a decrease in occupancy rate at one of the other malls, Tachikawa, from 100% last quarter to 88% currently, if you look at the numbers that they presented. But the what we understand from management is that the 88% is actually transitional. This is actually due to an expiry of a previous tenant. So that tenant has moved out, and then what we are seeing now is a transitional period, fitting out period for the new tenant. So as of October, which is last month, they have already signed a new lease with the new tenant at the same rate as the previous tenant. So as of where we stand now, we are actually back to 100% occupancy rate for that mall, so that 88% shouldn't be an issue or shouldn't be a worry at all. Then next, as I've said for CRT, most of their rentals and their leases are all pretty long term. So in that sense, we have a stable portfolio, and over the next 2 years, we should see very minimal renewal risks as well, because for 2016, we only have 5% of leases expiring. 2017, we only have 3% expiring. So next 2 years pretty stable as well. Occupancy cost remain low as well, slightly more than 8%, pretty similar, coming off a little from last quarter. Last quarter was about 8.4. So in our report, in our update report, we have also mentioned that there was this study done by this property research house. So they surveyed a spectrum of retailers to find out the sustainable occupancy cost for most of them in Japan, and it was found that the sustainable ratio is actually around 12 to 15%. So if you look at current occupancy costs for CRTs more at, at the low 8%, you actually can feel that the tenants will have a bit more capacity to pay higher rents when rental reversions come. So lastly, investors who are worried about the exchange rate and the forex exposure when they buy into CRT, you'll be pleased to know that the distributions for the next two FYs, 16 until FY 17, they are all already hedged by management on a fixed exchange rate. So next we look at a graphical representation of what is happening. You look at the line in red, that was what we earlier mentioned about the mall that was undergoing a temporary drop in occupancy. So you see that previously it's all doing 100%. This quarter, as of reporting end of September, reporting cutoff period, it dropped to 88, but as of now, we are already back to 100. And then as for the other malls, you can see that they're all pretty close to 100, all pretty close to full occupancy. And then these two columns, you'll see that these are what we have mentioned as well before. For the next 2 years, pretty stable, not much expiries, 5% in 16, 3% in 17. So With the acquisition, as we mentioned, WALE of the portfolio drops from 8.6 to 8.2. So we maintain our buy call on CRT with a target price of 93. Previously, we have a target price of 96, so we have downgraded the target price slightly, not because of any change in fundamentals or any blips in occupancies of the malls, but this is a purely for an adjustment for the rights issue that they have done previously, a 22 for 100 rights issue. So we feel that at current price, around 80 cents, you're getting a forward yield of about 9.5%. And for a portfolio that has a WALE of 8.2 years, a stable portfolio with 8.2 years of WALE, you are looking at one of the highest WALEs when you compare across the S-REIT sector, even if you compare across industrial REITs. So you have a stable portfolio. Your growth is going to come from when the acquisitions, the two acquisitions previously, One Small and Torias, their current rates are all at pretty significant levels, which are pretty significantly lower than current levels. So you get a kicker when the renewals come, and then you get a portfolio where exchange rate risk is hedged for 2 years, interest rate risk, they're all hedged 100%. Refinancing is only next round of refinancing will only come in 2017. So with all this positives for the portfolio at a yield of 9.5%, forward 16 yield, 9.5%, we maintain our buy call on CRT. So with that, we have come to the end of our webinar today, and we welcome any questions from all of you. Hi guys, Dahong here. Question on CRT. CRT, one of our listeners mentioned more leverage than other REITs and then pretty aggressive in acquisitions. So do we think that they will acquire more in the short term and then will there be another placement of rights again? So indeed, CRT is more leveraged than other REITs, but then one thing to note is that they are business trusts, so they're not subject to the 45% limit that MAS has set for the REITs. And then the second thing is that at this current level, around 40, mid 40s percent, this is a this is a level that management has indicated that they are comfortable with. They will try to keep it around this level. So if there were to be more acquisitions, I would suppose that it will have to be a pretty even mix of debt and rights or share placement. But they have been pretty aggressive in acquisitions. But the good thing to note is that, as we have also mentioned in our report, the the report was in I think September, our September report for CRT. We did a study on how the kind of acquisitions they've made throughout the years, and then it seems like they've got quite an eye for all these acquisitions because for all the acquisitions that they have done so far, they're pretty well in the money. And you look at the two previous acquisitions that they have done, they they are coming from a point of view which is like a longer term point of view in that current rates are a lot lower than current rates in the malls are a lot lower than what you are seeing in the surrounding proximity in the surrounding area. So you should expect a good kicker to your revenue when the next round of renewals come in. And I was talking about whale just now, right? About like CRT having long whales. Whale actually is weighted average lease expiry. Is a gauge of how long generally their leases will take to expire. Hi, Dong here again. More questions on REITs. One question is on the use for industrial REITs versus commercial REITs. Yes, generally industrial REITs pay higher yields than commercial REITs. And one of the reasons is because this is to compensate for the typical shorter leases, the land leases that the industrial properties sit on as compared to commercial REITs. And then I think that there are concerns on the ground on whether when the expected rate hike comes in December, there will be another sell-off for REITs. So our price targets are all for one year price targets. So if you look at all this short-term volatility, all this change in sentiment in the short term, these are what we are unable to forecast. But that being said, you know, like um, REITs rise in interest rates, REITs being like highly leveraged and vehicles which require acquisitions to grow and more funding to grow, Indeed, a rise in interest rates will be detriment to them. But then, if you look at general economic conditions, if we have had periods where we had interest rate rises, but the general economic conditions was also going good. So you see like office rentals were going up, retail rentals were going up because the general environment was bullish, like in a period from '04 to '07. So there can exist periods where interest rates go up and REITs go up at the same time. But that being said, we should note that currently for local REITs, there are a lot of headwinds for all those local centric REITs. Like if you look at retail REITs, retail sales this year have been sluggish, except for motor car sales. The last one that came out in for last month was not too good as well. Office REITs, they're facing huge supply increases next year as well. And this is coming at the same time when demand is dropping off. So office REITs is headwinds is there for them as well. Same for retail REITs. Industrial, Richard has already given you a detailed explanation earlier on. And then which is why a lot of the REITs we are recommending now are more towards the defensive side. You see like FCT, their suburban spending, which are supposed to be more resilient. First REIT is a resilient sector, healthcare in Indonesia. Croatia's is Japan consumption, which the government is trying to boost now. And then we have Capital Land Retail China Trust as well, which has been seeing decent tenant sales and rental reversions until now as well.
Hi, this is Richard speaking. There's a question for Viva Industrial Trust. Do we need to be of concern for its high gearing? Okay, firstly, we don't have coverage on Viva, but so generally speaking, um, if the gearing is say 40%, for example, then obviously they would need to do some kind of equity fundraising, maybe placement or rights issue. So that's one of the thing that you need to take note of. The other thing is gearing shouldn't be looked at in isolation. You should look at the um, debt maturity profile as well. So for some of the REITs, actually currently they don't have any refinancing requirements for the next 2 years because they've already done their refinancing this year. I'm not too sure of what is the debt maturity profile for Viva. Maybe they don't have any debt maturing this year. So that's um, the other thing that you should look at. Okay, we have come to the end of the webinar. Please tune in again next week and have a good look ahead. Bye.